Hello everyone, it's Paul here. I think we just had a little bit of a sound element there, but just to quickly do our risk disclaimer. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 83% of retail investor accounts lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please ensure you fully understand all risks involved. Forex and CFD trading is a risky activity, and this presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors. The presentation and accompanying video is for information and educational purposes only. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the difference between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with the maximum payout of £50,000. as per our negative balance protection policy. Admiral Markets provide a wide range of products and services to their clients. One of our most popular markets is the DAX 30, where we will offer a typical spread of 0.8 points during the main trading hours, and also 0.8 typical spread and no commissions for our best Forex pairs. We also offer the ubiquitous trading platforms MT4 and MT5. We also have the Admiral Markets MetaTrader Supreme Edition, which is a wonderful addition to those existing trading platforms. As always, if you have any questions about Admiral Markets or their offerings or their platforms, then please feel free to get in touch with your account representative and they'll be very happy to talk you through. So, ladies and gentlemen, my name is Paul Wallace. Okay, I'm here running the Admiral Markets Mastering the 4Ms of Trading series. I talk about myself as being a discretionary-based method trader. My primary work is to be a dominant trend swing trader. I like to keep things very simple. I mix fundamentals, technical sentiment, and geopolitics. Primarily, I'm sort of focused on FX indices and commodities, within which my philosophy is to buy strength, sell weakness. And I'm going to use pullback for entries, and one of those I'm going to share with you today as part of our sessions. When I'm doing my intraday trading, then I'm the opposite. I'm primarily a mean reversion trading, and that's something we'll come to touch upon later on in this particular series. As always, I like to set the expectations for our session. For me, it's to educate you about the 4Ms of trading so that you can go away and analyze the market and be ready to trade it. I also want to raise your self-awareness about managing risk and also about managing yourself. For yourselves, ladies and gentlemen, I appreciate we have a broad range of experience in the room. I appreciate we have, a time limitation of 45 minutes. So sometimes I can be a little bit limited on the breadth and the depths of topics that I can cover within our allotted time. So I'm always going to focus on simple tools that you can use tomorrow. Don't really want to go too much into the academics, although we do cover it. I want to be able to give you ideas and concepts and thoughts that you can take away and implement in your own trading straight away. So for those of you joining us for the first time, this is a series of webinars for Admiral Markets, all about mastering the 4Ms of trading. You should find all of the videos in the archive section and on the Admiral Markets YouTube page and also their Facebook page. What we've talked about throughout the series so far is that, from my own experience trading for myself, trading for funds, and also helping and supporting traders in their own journey, is that what we find is that the traders who do well continuously and for a lengthy period tend to have a good handle on mastering the 4Ms of trading. And those 4Ms are markets, method, money, and myself. And invariably there is a sweet spot where the trader is managing those 4Ms well, and that actually allows them to trade well and to deliver the kind of performance that they are looking for. And really this whole series is about covering those 4Ms. We've been looking in the first few weeks of it in the markets. Today we're going to focus a little bit on method, and then as we go on into the other months we'll be looking at money and myself also, so that we'll give you a full broad coverage of those 4Ms of trading. So, we talked about in some of our earlier sessions about, the importance of having, a nice, simple sort of routine that you can follow, almost that, whatever, instrument you choose to look at, whether it be cryptocurrency, whether it be equity, an FX pair, a sort of fixed income, or just even an index. That really you have to have a little simple routine that you can follow day in, day out, that basically allows you to do the right things every time when you're coming to trading. And we talked about having just, simple little, 5-6 step pattern that we could follow. Step 1, define levels of support and resistance. Step 2, define if there is a trend. Step 3, look for how price reacts at key support and resistance levels. Step 4, look for particular price action signals at support resistance levels. And then step 5, which we'll touch upon, are they part of a bigger chart pattern as we get into sort of steps 5, 6, 7 and beyond. So, every session I just have a couple of slides to recap on what we've covered, because, the more times you hear it, the more it's going to stick with you, the more it's going to become part of your own trading beliefs. It's going to be more about, how you operate in the markets yourselves. And that's what we're keen to sort of pass on to you. So I appreciate, as I said, we've got some very experienced traders in the room. We also have some new traders. That step 1 is about defining levels of support and resistance. And we talk about whenever you open a chart, look at the monthly, the weekly, and the daily charts and draw in horizontal levels of support and resistance. We can also use some of the psychological round numbers that we see, things like 120, 140. Okay, we've had 130 has been one in pound against dollar, although that's changed a little bit after last week. So and we also talked in one of the earlier sessions about how you can use fractals, which is an indicator on the Admiral Markets MetaTrader package, and you can use that to help draw in those levels of support and resistance. We also talked about, defining trend, okay, step 2, and we wanted to be able to do is, can we identify whether an instrument is trending or consolidating? It sounds very simple, but lots of people forget about it. Lots of people miss that, okay, in terms of how they operate. So I always put up this nice little simple chart of the weekly DAX. So you can see on the left, very clear that that market is in a range bound, okay, and then it breaks out, and then that market is in a nice uptrend. And this is what I talk about every week, okay. Then the good trends leap off the page at you. If you don't need to force it, if you're having to force it, well, then that in itself is telling you that it's it's not really working. It's not really the trend. The trend isn't there. Good trends leap off the page at you, okay. Don't force it. We also talked about having moving averages on our charts, and about how just using them for giving us an indication of the trend, an indication of the speed of the trend, giving us an indication of areas of dynamic support and resistance. On our charts, we have the blue 20-period moving average, the red 50-period moving average, and the green 200-period moving average. And that's what you'll see, and we'll talk about how we utilize them. They become quite important, especially with the little sort of mechanical trade strategy that I'm going to share with you today. So, and the sort of step 3 was, look to how price reacts at key support and resistance levels. And, we talked about what does it mean? What it is I'm looking for a confluence of events to happen at key levels. I'm looking for 2 to 4 things to come together to happen at a particular level. And that is what gives me a good trade trigger. That is what gives me the opportunity to sort of take a trade and join the trend. We talked about, also, just keeping it, just reinforcing the sort of the simple view that, when markets are bullish, you want to be a buyer. When markets are bearish, you want to be a seller. Define the trend and trade with it. No trend, no trade. No signal, no trade. Might sound a little bit simplistic, but as I say, in the sort of, in the heat of the battle, people forget these simple rules. And sometimes, the more times you're reminded of it, the more you're actually in a position to work with it and actually, sort of carry it forward as your own particular trading style. So, we've looked at step 1, step 2, step 3, okay, looking at big round numbers, moving averages, horizontal levels. Step 4 was, about looking for particular price action signals at support and resistance levels. And for the last couple of weeks, we've covered a couple of them, but, I thought we'd do something a little bit different today. But we'll just quickly, if you remember, we talked about, markets and method, and about how they are, how we're utilizing them in what we do, okay, and that's what our focus has been. We talked about, when it comes to different types of trading and investing methods, everything boils down to one of 2 styles. You are either trading a break of a line of support resistance, or you're trading a bounce off a line of support and resistance. And it really is as simple as that, okay? Sometimes, humans, and I include myself in there, sometimes we overcomplicate things. We make things a little bit too difficult for ourselves. And actually, we just need to keep it simple, keep it real. We're trading either a break of a line of support resistance or a bounce off a line of support or resistance. That's about it. They both have their pros and cons. Some people prefer to trade breakouts. Some people prefer to trade bounces. Personally, I prefer to trade bounces as part of a pullback in a trend. I'd say probably 70% of my trades are pullbacks rather than breakouts. But and the reason I like that is it gives me an opportunity to enter at a better price, and also I know if I'm wrong far sooner, and that makes a big difference to me. Okay, and that will become more apparent as we carry on with this particular series. So remember, step 4, we talked about a couple of weeks ago about different types of price action signals. One of them we covered was the pin bar. All right, it's a very frequent pattern, gives a great indication of supply and demand, support and resistance, clear and easy to see. Many people can trade them, okay, but not all. Like I will show you over the as we come to do the advanced levels of pin bar trading. But remember, we said it's a very frequent pattern that actually gives that can show up on charts very easily and makes a very good starting point for traders to work with. If you remember, we talked about a pin bar must have an open and close in the previous body of the previous candle. Candle wick should be 2 to 3 times the length of the body. We like to see a long nose that's protruding, and the better pin bars, they stick out and are very clear. What we talked about is, looking at pin bars as the kind of likely indicators of where the biggest predators are lurking in the markets, okay? They show rejection of a particular area or direction, and so as a private trader, we don't want to fight them, okay? What we want to do is we want to work with them. We want to use them to give us an indication of where the likely sort of next short-term trend is going, because we can use that information to trade well and actually, help us deliver a great trade opportunity. So that was pin bars. Then I think it was last week that we covered engulfing candles. All right. So you remember an engulfing candle, sometimes called an outside day or an outside bar. Okay. The high and low of the bar engulf the range of the preceding bar. And when I talk about the high and the low of the bar, I will include the wicks upon that as well. The high and the low of the bar engulf the range of the preceding bar. They're less frequent, but they tend to be more powerful when they happen at the end of a trend, because they can be used to signal a significant change in the trend or the sentiment that we are seeing in that particular market. So they don't happen as often, but they can be very powerful. So it's a simple 2-candle setup. The first candle closes in one direction, so you might close in green bullish. And then the second candle reverses and goes in the exact opposite direction, and the entire range engulfs the preceding candle. And I want you to think about the psychology of what it's showing. What it's telling us there is that effectively the sort of the market sentiment has changed. Okay, either in an uptrend the bears have stepped in and wrestled control of the market, or in a downtrend, the bulls have stepped in and wrestled control of the market. It's about who is in control of the market right now. So as I said, they happen rarely, but high probability. They demonstrate total overwhelm, and we want to see them at the ends of trends because they're a reversal pattern, all right? So if we're looking for pullbacks, things like pin bars and engulfing candles, they can help us. So we look for a bullish engulfing candle at the end of a downtrend, and we look for a bearish engulfing candle at the end of an uptrend. And we trade in the direction of the close of the engulfing bar. So there you go, ladies and gentlemen. That's a quick little recap of what we do. And as I said, the more you hear it, the more it sort of sticks with you, the more I want to go on. But today, I thought actually I'd just do something a little bit different. Okay, a little bit adding to the series, but just giving you all a very simple mechanical trading setup that is all about how to trade the pullback in a trend. And it's very simply called the 3-bar reversal setup. And that's what we're going to look to do. So Here we go. You know that we talk about, we like to find a trend. Personally, I like to find a pullback in a trend. Well, pin bars and engulfing candles can help us with that. But this is also kind of, a very, very simple mechanical setup that you can use, take away and use tomorrow in your own trading, regardless of whatever time frame you use and regardless of whatever instrument you're trading. So here we go. All right. How do we set up? Well, this works for both, swing traders using weekly, daily, and 4-hourly charts, but it could also work for an intraday trader, someone trading on maybe the 60, the 15, the 5-minute chart. What we use is the standard moving averages that we have, okay, the 20, the 50, and the 200, simple moving averages. Remember, the 20 is the blue, the red is the 50, and the green is the 200. And what we're looking for is we're looking for them to be in alignment. And what do we mean by that? That means that price is above the 20 period moving average, which is above the 50, which is above the 200 for a buy. And then we're also expecting to see that the trend has shown us price below 20, and which is below the 50, which is below the 200 for a sell opportunity. And that's what we've been looking to do. We're looking for basically an opportunity to sort of to join an existing strong trend. So here we go. Let's have a little simple look at it, a simple chat about it. Okay. So what's the first step of the setup? First step is, well, define is there a trend? All right, using the price structure and the moving average fans that we've talked about and covered for the last few weeks. For example, his price is above the 20 period moving average, which is above the M50 moving average, to define a nice uptrend. And then we're going to look for a pullback to enter a long. This is for a long trade, okay? Price is above the 20, which is above the 50, and that's what we're looking for. We're expecting it to be in a trend. We're expecting to continue that trend, even if we're having just a small little pullback within it. Step 2, in an uptrend, we want to wait and see that price retraces back towards support. Now, that support level could be either, a dynamic one in terms of a moving average, or it could be a static one in terms of a level of support resistance or a recent high or low. What we're just looking for is we're just looking for price to sort of, come back towards its support levels. And that's when we start to get interested. So, hopefully you can perhaps see there, that we've got a little chart there. Price has been in an uptrend, okay, but actually, even though it's an uptrend, we see it sort of falling back towards the sort of, falling back towards what is the 20 period moving average in this case. And that's what we're looking to keep an eye on. As I said, the level of support, okay, in an uptrend can be either dynamic or static. Once we get towards that support level, what we're looking for is a very, very simple mechanical setup that gives us a defined trade entry opportunity. So at the support level, if we have 2 seller bars followed by a buyer bar, then we look to trade back into the direction of the overall trend. If you want a very, very simplistic view of it, well, once price hits that 20 period moving average, in this particular case, I'm looking for 2 red bars followed by a green bar. 2 seller bars followed by a buyer bar. Okay, it's as simple as that. It's simple and it's mechanical, and that's that's what I'm sharing with you today, because I want it to be part of your sort of trading setup and part of how you go about actually engaging with and trading markets. So, as I said, the most simplistic view is that, for in an uptrend, we're looking for 2 red bars followed by a green bar. Simple as that. 2 red bars followed by a green bar. If the green buyer bar is also something like a pin bar or an engulfing candle, which we've already covered, or perhaps an inside bar or a doji or a spinning top, which we'll cover in the next couple of sessions, well, then this gives us even more confidence. Okay, we'd like to see a reversal, a reversal price action pattern for the green buyer bar. Okay, if we do, well, that actually gives us a much more confidence. You can see in this particular example, price was in the uptrend, price retraced back to the 20. We had the 2 seller bars followed by a green buyer bar, which was also a bullish pin bar. So all of that comes together. We've got the uptrend, we've had a pullback to support, okay, we've had 2 seller bars followed by a buyer bar, and the buyer bar is also a pin bar. Remember what I was saying earlier, I'm looking for a confluence of events. I'm looking for sort of 3 or 4 things all to come together at one place in time, and that is what gives me my trade opportunity. So how do we look to enter? Well, what we look to enter is in this sort of, let's say, our standard setup. What we're looking to do is, we will look to enter a position 1 pip plus the spread above the high of the buyer bar, and our stop loss is 2 pips below the low of the 3 bars. So that can be the sort of 2 seller bars and the buyer bar, and that's what we're looking for. A case of just being our stop loss goes 2 pips or 2 points beneath the low of those 3 bars. Our target, okay, to begin with, we'll just use a target, is 1.5 times our trade risk. So if our trade risk, entails 30 pips between our entry and our stop loss, well, then we're going to look to target 45 pips for a trade target, okay? So it's 1.5 times our trade risk. I know some of you might want to sort of use trailing stops. Some of you might want to use bigger targets. That's understandable. It's about, understanding your risk profile. But what I'm actually really talking about here is, this is just very simple mechanical trading strategy, okay, that you can take away and use. And for this particular, simple mechanical one, we're just looking to effectively have a target that is 1.5 times our trade risk. So for those of you who are a bit more advanced in trading, some of you who have maybe, let's say, a little bit more of an aggressive risk accepting, okay, mentality. Well, what you can also do is, you can also have what I would call an aggressive 50% pullback entry. So actually what we're now doing is we're entering a pullback of the pullback. So if we have, as we see here, we have the green buyer bar. Well, actually what I'm looking to do is I'm going to look to enter the 50% pullback within that actual bar. Our stop loss still remains beneath the sort of 2 pips beneath the low of the bar, but now our target is 3 times our trade risk. We have a lower hit rate, but we have a higher reward for our risk. And this is a point we've talked about, in the past, namely that, we can teach you pretty much everything here at Admiral Markets regarding trading. But the one thing that has to come from you is to understand your own risk profile. Some people are very risk averse. Some people are very risk acceptance. So only you know, which end of the spectrum you lie upon. And I can assure you that it's very, very important for you to find out and work that out, because that allows us to that allows you to sort of trade more effectively. So here's a couple of additional mechanical rules around about trade management. If the trade is not triggered after 3 candles, then take it off, okay? That's for the standard entry. If it hasn't triggered after 3 candles, then take it off, okay? Then, we're expecting a snapback, a move back into the existing dominant trend. And if that's not happening, well, then, we don't want to hang about. If for the standard entry, okay, if the price has continues to sort of to move, and it continues to, and it actually goes down beneath the low of the 3 bars without having triggered the sort of entry, well, then take the order off the platform. Okay, it's if the price is continuing down, well, then it's clearly still got some room for maneuver downwards before it actually sort of turns around. So if it continues down and closes beneath the low of the 3 bars before the actual order has been triggered, well, then that's just the time to take the trade off the platform. Once and if the trade does trigger, then just let the trade play out. Okay, just let it do its thing. Let it just work its way out. Okay, 1.5 times the trade risk is your target. Remember, so shouldn't be too hard to just let that trade play out, regardless of where it may take us. So, in terms of trade management, what I normally sort of tell to clients is look to do 20 of these trades and then evaluate your performance. For the standard trader, okay, the standard entry, you're looking for a win ratio of somewhere between 48 to 58%. For an aggressive trader, your win ratio is going to be much lower, okay? Your win ratio is going to probably knock around between sort of 30 to sort of 42%. Well, the question is, can you be profitable if you're only right 1 in 3 times? Well, with the right reward to risk, yes, you can. Yes, you can provide with positive expectancy. So, you can see that hopefully, even if you're doing a 50% hit rate with a 1.5 times your reward to risk, well, then that will allow you to sort of generate consistent profitability. So that's what I say. Just set up, do 20 of these trades, and then evaluate yourself. Evaluate how those trades have played out. And with that data, you'll also be able to start sort of adapting your trading to what the trading conditions are. So for selling, well, actually, the setup is exactly reverse for selling opportunity. So whereas for a buy, you were looking for 2 buyer bars, 2 seller bars followed by a buyer bar. Now we're looking for 2 buyer bars followed by a seller bar. So that's there's 2 green bars followed by a red bar. Okay, it's just the flip. It's just the mirror of the flip in terms of the actual setup of the trade. So here's a couple of examples I've got. I've included like sort of 6-7 examples in. This is the euro sterling. This is a 15-minute chart, and we can see price pushed up. Okay, and put itself into a trend. Price was above the 20, it was above the 50, and then actually price came back down towards the area of the 20 period moving average. We had 2 seller bars followed by a green buyer bar. The green buyer bar was also a bullish pin bar. So we were able to sort of enter the trade 1 pip and spread above the sort of the high of the bar, and our stop loss was just beneath the bar. Okay, and we had a target there of 89.29. So it's actually a very small, tight tight trade. There's only sort of 9 pips of total trade risk. Okay, but we were still able to sort of hit our target and generate our 1.5 reward to risk on our trade. Here's one also for the pound against the yen. This is the sort of 3-bar reversal setup. So you can see price gets beneath the 20 period moving average. We can see that we've got the 20 heading down, the 50 and the 200. We can see that as soon as the 20 crosses the 50 to the south side, well, now we're in the right conditions for that trade. The trade pulls back towards the 20 period moving average. It puts in 2 buy bars, 2 green bars, followed by a red pin bar, and actually what happens is price triggers and price drops. Interestingly, you can see that the price actually gets very, very close. I mean, literally goes to the pip of its target, but it doesn't get taken out on the spread, and actually the trade just reverses and runs away, and then actually overnight sort of rolls over again and comes back and actually hits our target. So as I said, this is a simple mechanical way to trade, but it also requires you to effectively just allow the trade to play out. Okay, allow the trade to do its business. Sometimes that trade just needs a little bit of time and breathing space for it before it will hit its target for you. Here's an example for this is the pound against the Swiss franc. Okay, and what we actually have here is that price was, you can see that price had got itself into a nice uptrend. I remember I was saying good clear trends stand out. Price retraces back to the 20 period moving average there. Okay, it actually puts in an engulfing candle there. Let's just see if we can use some of the drawing tools. Okay, so here we go. We have we had 1, 2, and then 3, which was 2 seller bars followed by a buyer bar, which was also an engulfing candle. So remember, we're saying when we see that gives us much more, that gives us a lot more positivity, a lot more confidence, and you can see that trade took off and shot its way up towards its target. So this is all about just being very mechanical. Okay, just about basically following just a very simple mechanical trading idea. Okay, and you'll find that it happens and acts on all sort of instruments and all time frames. Doesn't matter whether you're trading the 5-minute chart or the monthly chart. You'll see that it's it's very much driven like that. Here's an example from silver. Okay, so this is the 4-hour chart on silver. Let's get the old drawing board up again. Okay, so here we go. So we can see that we had 1, we had 2, and then we had 3 here. Okay, so we'll be looking to sort of enter the break of that, and actually we can see that invariably that just dropped really nicely. That's what we saw. Okay, and it was just almost like a picture perfect trade setup. We have a flag pattern, we have a pin bar, we're bouncing off the 20 period moving average, we've got a 3-bar reversal setup, we're in a nice downtrend. Okay, it's pretty much everything is just coming up very nicely, and that's what looks good for us. Okay, that's just a normal good trade setup for us. This is a rather interesting example from very local charts. Okay, so just from this month at the moment. In particular, it's the Australian dollar. Those of you who've been watching, the Australian dollar, those of you who will have joined me for the Tuesday morning London time real-time daily trading ideas session at 10 o'clock. We'll talk about, I've talked about how effectively, Australian dollar has not been terribly popular as a currency these last few months, and invariably every man and his dog has been trying to sell either they sell the Aussie dollar, okay, or they've basically been just looking to sort of accumulate positions. And this is a daily chart of the Australian dollar against the US dollar. Hopefully you can see it there, and actually hopefully you can see we're in a nice downtrend, okay, but even then we can still see that there was lots of these 1, 2, 3-bar reversals sort of setting up continuously across the over the last couple of months. We've got 1, 2, 3, 4, 5. We've had 6 of them over the last 3 months, okay, which is just it's fascinating when you think about it. Just as I said, it just shows that we can watch these setups on all time frames, okay. We can also see them on all instruments and all time frames, regardless of whether you're a daily trader or whether you're a 5-minute trader. Okay, these patterns set up all the time, and and if I said if you've had a bit of challenging trying to find or follow a trading strategy or system, well here you have one here that will allow you to effectively just effectively be very mechanical. Okay, it's very clear, very simple. Okay, it's we've just gone through there the rules for it to know how to make it very simple, how to make it work, and we know that we can do that very easily, and hopefully you realize that that's a great sort of trading opportunity for us all, okay, to be able to sort of take that for able to sort of take this and use it in our own trading. So, ladies and gentlemen, in conclusion, okay, the 3-bar reversal is a simple mechanical pullback trading tactic. All right, very simple. 1, define if there is a trend, which is for an uptrend that is price above the 20, which is above the 50, which is above the 200. For a downtrend, that is price is beneath the 20, which is beneath the 50, which is beneath the 200. You're looking for it to wait for a pullback to support or resistance if you're shorting your trade. And then once we see price pull back to those levels, what we're looking for is for a long, we need 2 seller bars followed by a buyer bar. So we're looking for 2 red bars followed by a green bar. And for a short in a downtrend, we need 2 buyer bars followed by a seller bar. So that's 2 green bars followed by a seller bar. And that gives you your very simple mechanical trade setup. You know that you're using your target as 1.5 times your trade risk. And also we know that our stop is just going above, the low or the high of the 3 bars, okay, depending upon which direction you're looking to trade with it. So as I said, I challenge you to take this away. Just go and do 20 trades of it. See how you get on, all right? See how it works for you. What you might find is that, you might find that actually, the target's a little bit too conservative, and that you can actually make further from your own trades. that's absolutely fine. You might actually, find that you particularly like it on certain instruments or certain time frames, and that's absolutely fine, ladies and gentlemen. That's absolutely, if anything, I've done you a service there, because you're an ability to sort of or have the ability to identify identify a very, very simple mechanical trading system to follow. So we've got a few minutes left, so we'll go and take a little look at at some opportunities there with regards to that. But as always, we're going to look at the 4M profile, which will get more more complete as we go through our sessions, and we'll talk about using the dollar index and then effectively the 28 major FX pairs. Okay, that's the major FX pairs and how they cross trade with each other. We're looking at indices, the S&P 500, the Dow Jones 30, the NASDAQ, the FTSE, and the DAX, and the Nikkei. We're looking at commodities, oil, gold, silver, and copper, and also the sort of soft agri ones as well. Equities, a lot of people like to follow the FANGs, okay, but you might have your own particular personal faves that would work, okay. And then crypto, well, of course, Admiral now offer a range of cryptocurrencies to trade in terms of Bitcoin, Ether, Litecoin, and Ripple, and that can be used to they can be used on this. As I said, this is a very simple mechanical trading system, okay, that we're looking to share with you, something that you can, as I say, you can take away and use tomorrow, and that's where we particularly want you to be. So remember, ladies and gentlemen, this is about mastering the 4Ms of trading. So we always need to remember to manage those 4Ms, okay? Markets, method, money, and myself. Have to ask yourself, are they in alignment? If not, then don't expect outsized returns, okay? Constantly monitor yourself against them, see how you're doing. If you're having a little bit of a challenging time, well then just maybe spend a little bit of time sort of just writing down where you are or where you see yourselves are in each one of those 4Ms of trading. And I suspect what you'll find is that the solution will come to you relatively swiftly. So there you go, ladies and gentlemen. If I hope you found that interesting. I hope that's given you some food for thought. If, as always, you have extra questions, whether it be about the session or about things you'd like to see or about Admiral markets themselves, then feel free to call them on the London market, on the London number there, 020 4003. You can email them at hello@admiralmarkets.com. They'll also have their YouTube channel, Admiral Markets, and Facebook is Admiral Markets Global there as well. So be sure to sort of take a look, take away these slides, okay, watch them again, start to pick up and identify where and how you could use that very simple mechanical trading setup in your own particular trading. Now, if you'll wait with me for a moment, I'm just going to try and switch across to the charts. Let's hope that works, and we can just have a quick look at a couple of ideas for a few of the last moments. So I see there's a question there, Jack, saying do these setups work with Heiken, Ashi, and Renko bars? Not really, Jack. This is purely just about simple, normal price action candlesticks. Okay, that's what they're there for. Okay, just very simple. I couldn't tell you whether they would be viable with Heiken, Ashi, and Renko bars. Okay, there's just very simple very simple price action candlesticks. That's what's provided on the actual platform, MetaTrader 4 and 5 platform by Admiral Markets. So yeah, there we go. There's that Aussie dollar chart I showed up there. It was kind of surprising to see. We can see lots of 3-bar reversal shorts. Okay, that's what we wanted to see. Okay, you can see we've got 1, 2, and then 3, which is a spinning top as well. Remember, okay, it's a spinning top. So actually, yeah, we'll trade down to there. Okay, and that will give us our 1.5 to 1. Then immediately after we're just taken out for 1 to 1, we're actually 1.5 to 1. Sorry, but we actually set up again. Okay, we actually do set up again. We see 1, 2, 3. I'd look to trade that on a pullback. Okay, because of the size of the number 3 candle. Once again, once that triggers, we also set off another 3-bar reversal setup. Okay, you can see it here. We've got trade 1, trade 2, and then trade 3. And that trade 3 is also a very strong kind of bearish candle. It's, you know, what I would term a domino candle. It's something I'll happily trade, and within a couple of weeks you too will know all you need to know about domino candles and how to use them within markets. But we weren't done there. We had, you know, we've had 2 final further moves. Okay, we can see price has, you know, price basically, you know, moved up here. We've got 1, 2, and then actually it looks like a little bit of an inside bar there, doesn't it? Actually, a little bit of inside bar, you know, that is there before it triggered. I'd like to think we'd have got our 1.5 to 1. I think that was to do with a particular Middle Eastern bank, but we can see it flipped back and then it set up again, and then it ran down there. Okay, very, very nicely. So as I said, you'll see these across all sorts of time frames, all sorts of instruments. Okay, it's just about just getting yourself, your mind in the right place to be able to just talk about them, to see them, to actually to trade them, to journal them, and then to improve on them. Okay, and that's actually all we can ever really do. So let's have a look. I was looking at the sort of Dow Jones just before we came on here. Okay, I was just you know, just looking for the trade there. You can see that has worked down very, very nicely. You know, what I worked at, you know, it's not normally my style at all. So this just was, you know, what I do is I write these things in after the event, because I can gives me an idea of what I'm particularly looking for. Okay, what I'm actually sort of intrigued to work with. Okay, so, and it adds us up that interesting conundrum there. Okay, that here we go. It gives us the conundrum. Let's just see how that goes. Brilliant. Brilliant. So, you know, as I said, you can see that there's the 1, 2, 3 there. Okay, you know, you can see we had 2 buyer bars. Okay, followed by a seller bar. Now, admittedly, the seller bar is quite big. It is quite big. Okay, and that's probably where we'd be looking for the 50 period. The 50 period, you know, the 50% pullback. Okay, on the candle. Okay, to actually to do that. In this particular case, it you know, the sort of the standard entry would have taken you in, but the 50% pullback wouldn't. But as you can see, that was just an entry into a trade. You know, what it could be, you know, what we'll be looking at is just how that, you know, that 0.3, okay, is actually also where the 20 crosses the 50, and that's where we're particularly intrigued and interested in terms of looking at what is available for us. So you know, here we have sort of another one on this is on sort of weekly Bitcoin. I'm just trying to show you a few that will give you a little bit of idea, a little bit of a heads up here. Okay, so we just have here we go. There we go. You can hopefully see that was, you know, the third. You know, we had 2 seller bars followed by a buyer bar. That buyer bar was a very small sort of inside bar, kind of spinning top almost. You know, that which is viable, as we've said, as a trade option for it. Okay, so it's a case you can hopefully see there. Okay, 1, 2, 3, and then you know we quite happily moved on to making our 1.5, you know, trade 1.5 times. If I go down to the daily chart, you know, as we've seen, price kind of doing that move there. Okay, you know, in terms of it's been a kind of a nice downsized move. You know, we can see that there will have been quite a few opportunities and examples where price has rallied up there. Okay, and shown a kind of 3 bar reversal there very, very quickly. Okay, ladies and gentlemen, so we're going to draw it to a close there. Okay, I hope that's given you a little bit of insight. Okay, I hope that's helped you sort of just pick up a very, very simple mechanical trading system. Okay, very, very simple, nothing too elaborate. Okay, but very often the best traders are able to sort of trade very, very simple trade setups, and that's what we like to do. Okay, that's what we like to sort of share. Okay, just very simple trade setups that everybody could use to basically allow them to sort of you know, have a good, simple mechanical trading system to follow. Thanks very much for the feedback, Phil. Great webinar, he says. That's really good. Jack and Christine both say thanks. That's very kind of you. Okay, I look forward to you joining me next Monday. Okay, to go through our next session in Mastering the 4 M's of Trading. For those of you around on London time, tomorrow will be the real-time daily trading ideas for Admiral. Okay, I'm there every Tuesday morning at 10 o'clock. You're very welcome to join us, where, you know, actually a lot of the stuff we talk about on the Mastering the 4 M's of Trading, I'm actually utilizing specializing in what we do there on the real-time daily trading ideas. Great to speak to you. I wish you all the very best of success in your own trading, and I look forward to speaking to you next Monday. Trade well, everybody.